Hey there everyone! Welcome back to Bull and Bill, where we turn financial learning into something approachable and, dare I say, enjoyable. Today, we're tackling one of the most popular and sometimes daunting topics in investing stocks. Whether you're a beginner, a casual investor, or just curious, we're going to unpack everything you need to know about stocks, from their history, types, and how they work, to the potential benefits, risks, and practical steps to start investing. So, grab a coffee, get comfortable, and let's dive in. First, let's demystify what a stock actually is. When you buy a stock, you're buying a small piece of ownership in a company. This makes you a shareholder, which means you have a claim on a portion of the company's assets and profits. Pretty cool, right? But what do companies get out of selling shares? Well, by offering stocks, companies raise money to grow their business, fund new projects, or manage debt. But here's a crucial point. Owning a share doesn't mean you're managing the company. You don't get to walk into Apple's headquarters and start making decisions. Your power as a shareholder typically comes in the form of voting rights for major company decisions if you own common stock. Speaking of common stock, this is the most typical type of stock investors buy. It offers the chance for capital appreciation and sometimes dividends, plus those voting rights I mentioned. But there's another type of preferred stock. Preferred shareholders usually don't have voting rights, but they get paid dividends before common shareholders do, and if the company ever runs into trouble and has to liquidate, preferred shareholders get their money back first. Let's step back in time for a second. Did you know that the idea of trading stock dates all the way back to 1602? The Dutch East India Company was the first to issue shares to the public, creating the first official stock exchange in Amsterdam. This allowed people to invest in lucrative trade voyages, reaping profits or sometimes suffering losses, depending on how successful the trip was. And from that humble beginning, the stock market evolved to become the bustling global network it is today. Modern stock exchanges like the New York Stock Exchange and NASDAQ are key players where shares are bought and sold every day. So how do stocks make you money? Let's talk about two main ways: dividends and capital appreciation. Dividends are essentially profit-sharing payments companies make to their shareholders, usually on a regular schedule. While not every company pays dividends, those that do are often viewed as stable investments. For instance, blue-chip companies like Coca-Cola or Johnson & Johnson have a long history of paying consistent dividends. Then there's capital appreciation. This is where the magic of the stock market often lies. If you buy a stock for $50 a share, and its price rises to $100, you've doubled your initial investment if you sell. But of course, prices can go down too, and understanding what moves the stock market is essential to making informed decisions. Let's bust a common myth. The stock market is just for the rich or high-stakes gamblers. Nope. While it's true that some investors are high-risk day traders, the majority of stock market participants are people like you and me. Individuals building their savings, planning for retirement, or investing for their children's future. And here's another one. You need a lot of money to start investing in stocks. Thanks to modern investing tools and fractional shares, you can start with as little as $5 or $10. This democratization of investing means anyone can own a piece of big-name companies without spending a fortune. Now, let's get a bit more specific about stock types. Growth stocks are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. These stocks often reinvest earnings back into the company instead of paying out dividends. Think tech companies that are constantly innovating. On the other side, we have value stocks. These are shares of companies that trade at a lower price relative to their fundamentals, such as earnings or dividends. Value stocks are considered underpriced by the market, making them attractive to investors looking for bargains and long-term gains. You've probably heard terms like the Dow Jones Industrial Average or the S&P 500 thrown around, but what do they mean? Simply put, these are market indexes, collections of selected stocks that represent a portion of the overall market. For instance, the S&P 500 is composed of 500 of the largest companies in the US. By tracking these indexes, investors can gauge the health of the market as a whole. But let's not forget, investing in stocks comes with risks. Stock prices can be affected by numerous factors, including company performance, economic indicators, geopolitical events, and even social sentiment. A bad earnings report or a global crisis can send stock prices tumbling. That's why diversification is one of the most important principles in investing. By spreading your investments across different industries and sectors, you can reduce the impact of any single stock underperforming. Now, if you're ready to take that first step, here are a few tips to keep in mind. First, choose a brokerage that fits your needs. Whether it's a full-service option like Merrill Lynch or an online platform like Robinhood or Fidelity, find one that aligns with your investment style. Second, start small and be consistent. Investing is a marathon, not a sprint. Even if you only invest a small amount each month, it can grow significantly over time thanks to the power of compound interest. And remember, you don't have to go it alone. Consider using index funds or ETFs that track a whole market segment, giving you instant diversification. Before we wrap up, let's go through a couple of frequently asked questions. Can I lose all my money in the stock market? Technically, yes, but it's rare if you diversify properly. Even if one stock tanks, others in your portfolio might perform well, balancing the loss. And how long should I hold on to a stock? While day traders hold for mere hours, long-term investors often see the most growth over years or even decades. Patience is often rewarded in the stock market. So here's what we've learned today. Stocks represent ownership in a company, offering potential profit through dividends and capital gains. There are different types of stocks to suit different investment strategies, from growth to value to dividend-paying stocks. While the stock market carries risks, smart investing strategies like diversification can help mitigate them. Thanks for tuning in to BullBill. If today's video helped you understand the ins and outs of stock investing, don't forget to give it a thumbs up, drop any questions you have in the comments, and, of course, hit that subscribe button for more content that makes finance simple. Remember, investing is as much about staying informed as it is about taking action. See you next time, and happy investing!